Good morning, everybody, and you're very welcome to today's Policy in Practice webinar, another of our bi-weekly webinars, and it's great to see so many people here on the call today. Today's webinar is on recapping the major benefit changes and coronavirus COVID-19, and it's great to see so many people here, as I say. Just while we do get started, a little bit of housekeeping. In the panel on your right-hand side, if you're not already familiar with this platform that we use, please could you raise your digital hand just by way of an audio check so that I know that you can hear me, okay? And while you're doing that, in that same panel on the right-hand side, that's where you can ask questions of our presenters today. So please do pop your questions in as and when they occur to you during the webinar, and we will have a good 10 minutes at the end to get to them. We'll have a poll to keep things nice and interactive, and also a survey at the end of the webinar as well. So do please stick around for that and give us your feedback and do some next steps. And we aim to have you on your way by 11:30, and you will get all of the slides and this recording automatically after the webinar. So no need to worry about taking notes. So thank you very much for raising your hands. It's great to see that. Thank you very much. So let's move on, and I want to introduce you to today's speakers. So a lovely active panel today, four voices, four different faces on the screen here. We are going to be joined by our Head of Policy, Zoe Charlesworth from Policy in Practice. Zoe, if you want to say hi, I think you might be muted. Hi, Zoe.
Yeah, good morning, everybody.
Morning, Zoe. We're delighted to be joined by Victoria Todd, Head of Low Incomes Tax Reform Group. Victoria, do you want to say hello?
Yes, good morning, everyone.
Hi, Victoria. And my colleague, Mclean. Megan, would you like to say hello?
Hi, morning, everyone.
Lovely, Megan. And also my colleague, Peter Carter. Do you want to say hello?
Good morning, everybody. Good to have you all with us this morning.
Lovely, thank you everybody, and more of the speakers shortly. Very quickly before we move on to the speakers though, for those of you who might not have heard of Policy in Practice before, just a little bit by way of introduction about who we are. Actually, before I do talk about Policy in Practice, I just want to say that we are living in unprecedented times, and it's thanks to organisations such as you on the webinar today that we will get through. So I want to say thank you on behalf of Policy in Practice for all of the work that you're doing. And by way of quick introduction, if you've not heard of us before, we help organisations like local authorities, housing associations, citizens advice, frontline organisations to give the best support that you can to help people on their way. And we know that life's tough at the moment for very many people, and indeed yourselves as you deal with so much pressure. So if there's any way that we can help you to do that, please do reach out to us, and we'll be very happy to help. So thank you. Today's agenda, we're going to be going through, Zoe is going to give us an overview of the COVID-19 changes and more so concentrating on some of the key issues, some of the impacts that have come out of those changes. Victoria then will take us through some more recent developments and give us a focus on the tax credits issues. Megan will talk about the concerns that we know people have come to us with questions about, and I think that's quite an interesting way to share that with you. And Peter will talk about solutions, how the organisations that we work with are responding to these challenges. And as I say, there's time for question and answers at the end, plenty of time. So that's what we're going to be talking about today. And just to get us on our way, I'd like to serve a poll, if I may. Just one poll today, because we have so many speakers, lots to talk about. But to kick us off, hopefully you can see this there on your screen. We are interested in what are you struggling most with at the moment? Times have moved on. It seems time is a very strange concept at the moment. I'm sure you'd agree. But thinking back to maybe a month ago, 12 weeks ago, you know, when things first happened, there would have been challenging issues for you then. But time's moved on, and what are you struggling most with right now? And I think that's going to really be useful information for our speakers. Thank you very much for the votes coming in. I see everybody putting a hand up and choosing particular options. So the options that I've got there on screen, hopefully they do cover what you're looking at yourselves. But do you feel that you've got too much demand for your services right now? Do you feel that you're not reaching out to the most vulnerable people? Do you feel that you're being too slow getting support to people? Do you feel that there is uncertainty over future demand for your services? Or do you feel that the number one thing you're struggling with is not having enough information or guidance to give to people, or indeed for yourselves? Brilliant. So I think we've got most people voted now. So I'm going to close the poll and then ask our panelists to have a comment on that. So just bear with me while I share that, and you should see that there on your screen. Brilliant, very interesting. So Zoe, can I ask you, do you have any comments on those results there on the screen? 43% saying not reaching the most vulnerable people is the number one thing they're struggling with at the moment.
Yeah, and what's really interesting about this is much as saying that we would expect this to be, if we had done this before any of the COVID-19 impacts had happened, we would still expect, I would imagine we would still see this as the most likely selection. It's a problem that all housing associations, local authorities, advice agencies, CABs struggle with. You're relying on people being informed enough to actually seek you out and seek out your services. And local authorities have the option of obviously using data analytics to try and pinpoint those who are sort of hidden. I mean, in general, this is usually private tenants who and we just don't know those vulnerable people who are out there. And there's also an awful lot of people who are vulnerable who aren't seeking help because they're not, first of all, they're not sure they fit into the categories, but otherwise they don't want to be a burden. It's a real problem. Housing associations, citizen advice, have much a harder time reaching these people than local authorities. And I think some local authorities are doing incredible work. I won't go into that now, but if people want to find out more about that, just get in contact with us.
Brilliant, thanks Zoe. Now, without further ado, staying with you, Zoe, over to you now to look at the at your section, COVID-19 changes.
Yeah, so I'm going to just run through some of the main impacts of some of the changes. I'm just waiting for the first slide to come up. The first slide is actually a picture of our web page, and I've only got this up to remind us of the number of, if you look on the right-hand column, the number of benefits that have been impacted by measures that have been introduced to support families through the COVID-19 period. And it's a long time ago, isn't it, since we first heard about some of these. I think it feels like it's forever, and I think we've all sort of working from home has become normalised. But actually, this is all very new. We're still hearing about the ins and outs of some of these schemes, the details. I'm not going to go into them in an awful lot of detail today because we've got Victoria Todd with us, who is like the known expert on the interaction of employment and benefits. So I'm not going to go to big detail. I just wanted to say that on that webpage, you'll see on the right-hand side, we had schemes, and on the left-hand side, we had circumstances, because what we found was that people weren't interested in a particular scheme. They were looking at interactions. And of course, all these schemes, they do interact with each other. The main two, obviously, the coronavirus job retention scheme, which was being paid to the end of June. Now, there's lots of discussion about what's going to happen to that, and we'll come to that at the end of my my section here. You can get up to 80% of your pay, up to 2,500, where it's capped out. We do know that the average is actually about 1,500. So the most people being affected by these schemes are actually the low-income employees. They're being affected way more. They're taking up the coronavirus job retention scheme and the self-employed scheme to a much greater extent than those who are actually affected by the cap. Yeah, the next one is the coronavirus job retention scheme. As I said, I'm not going through the details because we're going to leave that to Victoria. The next one, the self-employed income support scheme. Now, this is open to people with trading profits of under £50,000, but we know that the average grant from this is going to be about just over 1,000 a month. So again, this is people with mostly affecting people who are actually claiming through this. Mostly those on low incomes. I don't think that's going to be a surprise to anyone who works in the welfare sector. We do know that financial resilience is at all-time low after all these years of austerity measures and benefit freezes. And we do know that only about a third of households have savings above 1,500, and average household debt stands at 15,000. So the people who fall into that category are the ones who are likely to be applying for these schemes. A lot of other people have been furloughed. That's not saying it's only applying to those. It's 1 in 5 employees now in the UK. So it's a huge numbers. I think that I think the current numbers are over 8 million have been furloughed at some point, and at any point it's about 6.5 million. So these are huge, but we do know that the average amounts are quite low. Yeah, I'll move on. I'm just going to look at some of the impacts of having all these changes. The first impact I want to look at is the impact for DWP, who I have to say have surprised me, perhaps wrongly, but probably surprised most people in the amount of flexibility they're showing towards claimants affected by the economic downturn. Yes, this graph on the right is just fantastic, isn't it? Look at this. I'll just give a minute while we watch it. That's fabulous, isn't it? The universal credit claimants. This slide says 1.8 million declarations. I think it's 2.3 million now, and we're expecting another 2 million in the next quarter. So some of the 2.3 million on might not stay on, some of the 2 million who there. I mean, and the predictions for the next quarter. There's been 2 main ones, one by the OBR and I can't remember the people who did the other one, but they're very, very different, very, very different predictions. They were not actually sure what will happen in the next quarter. But we do know that housing associations, local authorities, citizens advice, welfare organisations like us will have received huge numbers of inquiries. Traffic to our benefit and budgeting calculator quadrupled during these first few weeks, and we answered thousands of questions from our website where people wrote in directly to us about their individual circumstances. And that has calmed down. Certainly the traffic has calmed down, but we're still seeing a lot of people who are now looking for the nitty-gritty about these schemes, which Victoria is going to look at some of the emerging issues. We did some data analysis on the benefit changes, the £20 a week additional income to the base allowance, £20 additional increase to the base allowance for universal credit and tax credits, and also the increase in LHA rates. And we found that there was an extra 6% of households that will be able to meet the standard expected bills for their household type. So that means that more people will manage on a day-to-day basis. So that is incredibly welcome. And the average increase in UC awards from April 2020 was £98 a month. That's going to be very welcome for the people who are having to rely on means-tested benefits. Have the next slide, please, Janet. But it has left us with all sorts of very strange impacts between different types of benefits. So the first one, legacy against universal credit. I'm sure you've all come across this when you're advising people, because these increases weren't applied to legacy benefits. For a lot of people, they'll actually be better off on universal credit. This will obviously cushion the surprise and shock as they move over to universal credit, which they will eventually. But it does mean that some people are weighing up whether they should try and move over earlier. Now, some won't have the option to move over. But for tax credit claimants in particular, there's a lot to take into account here, which Victoria will be covering a bit later. Thanks, Jane. The next impact that I think that we is actually looking at tax credit. Update. I don't know if you've got the next slide, but I'll carry on. Yeah, so for tax credits, the options between selecting tax credits or universal credit. And Janet, oh, there we go. Yes, it might just be me. Slow internet connection. Was working from home is always a problem. So much to take into account, isn't there? Victoria will obviously be discussing this, but the only point I wanted to make about it was that for us at Policy and Practice, when we're giving advice on this, it does come down to individual. There's no blanket advice you can give on this one. It comes down to an individual circumstances. There are certain things you can look at, like whether they have savings or not, but really people have to make individual decisions about short-term gain and maybe long-term impacts. For example, I mean, in particular, self-employed people who might well have the minimum income floor reinstated in the future, and whether people can get through the 5-week gap. It's all of this decision about tax credits and universal credit, I do think do require an understanding of the claimant's circumstances and the claimant's particular financial resilience at the time. The next area I want to look at is the impact of the benefit cap and its interaction with these new increases in benefit support. Most people will be aware of this. There's a lot of discussion about it. And actually, I think it's probably the most common request from advice organisations is for the lifting of the cap or removing the cap. If you look at this, these graphs here, you can see that in London, very few households actually benefit from the increase in the LHA and the increase in those basic allowances. Outside London, yes, they do, until you get to 3-bedroom properties or 2 children in 2 bedrooms. But if you look at the increase that people would have got without the cap, it's hugely different. And I think what we have to accept is that most people in London, I think it's most household types except couples without children, they will not see these increases. So I have noticed that every time a government minister is questioned about this, they come back with these figures about the increase in the LHA to the 30th percentile and the £20 increase in basic allowances. They very rarely just say that for private rented tenants with children, this just does not really apply. In London, you can just say it doesn't apply, more or less, and outside London doesn't apply to very large categories of people. Thanks, Janet. I think the reason that people are calling for the end of the benefit cap comes down to does it meet its initial objective? And the justification was fairness between those working and those not working, but that's gone ages ago. The benefit cap was, set at, I'm trying to remember now, but on medium wages about 2012, 13, and then it was reduced. The benefit cap was further reduced in 2016. So it's this fairness principle has gone a long time ago, but it was an incentive for people who could work to work. Does that hold? Does that still hold true now that we've got economic situation that makes working more challenging? People who are perhaps sick, perhaps shouldn't be mixing, going to work. It's one of the, I think it really is, there is a real push on the government to look at these initial objectives and say, is this actually fair anymore? There's also the issue that we've got a cap, haven't we, for the benefit cap for people who end up in receipt of universal credit, which is very different to the furlough cap and the self-employed cap. So it sort of belies the level that the government thinks is reasonable to support households. It's why are there 2 levels? And the final issue, which is really important, is the impact on local authorities in maintaining this cap. Up to now, households haven't had their rent met, private sector rentals, and people having benefit cap. It's been met to a large extent through DHPs, although those have mostly gone to social rented tenants. But that comes back to the very first poll about how do you find your private rented tenants that need support. But local authorities have only received 40 million extra on the DHPs than was expected pre-COVID. That's what, if we're expecting 2 million more claimants in the next quarter, that's £20 each. That's not really going to help with the benefit cap or restrictions on LHA on an ongoing basis. There was, yeah, so that's, the other, sorry, just went on a bit, I was about to say something else, went on a bit far there, but we'll move on. So from having these coronavirus job retention scheme and the self-employed income scheme and the old universal credit scheme, quite often it's just chance that you end up in one or the other. You started self-employment too late. You started your work on a date past the cut-off date for the furlough scheme. But so we've now got two parallel schemes which have got inequitable welfare support. And these new schemes are not targeted or means tested. There's a huge amount of conditionality and means testing around universal credit. The others, there's no conditionality, they're not targeted. And if you had a household, this is an extreme example, but if you had a couple both qualifying for the new schemes, they could receive £60,000 a year basically in benefit income. But a similar couple on universal credit would receive £7,000. That's a huge, huge difference. If we just move on to the next slide. I've got an example of here of Jack and Jill. They're both lone parents with 2 children, renting at the LHA rate. Both earned £30,000 a year before COVID-19 hit. They both started work in the last year, so they weren't exempt from the benefit cap. Jack has been furloughed, Jill has been made redundant. And look at the difference in their income, it's £1,000 a month difference. And the thing about this is that Jack and Jill have no choice in this. Jill doesn't have the choice to be furloughed, that's up to her employer. So this is out of their hands, this is completely out of their hands, that the difference in income that these households will have to live on and their children will have to live on. Thanks, Janet. Oh yeah, this is just a reminder that the reason that Jill was affected so badly there was the benefit cap. So this is from our calculator and it explains, these are just alerts that explain the things that have affected Jill's entitlement. But it also actually, very good point, just go back to that. When we're giving advice to people who are writing in, it's really, really important that we don't just concentrate on the main schemes out there. Obviously, the first step for anybody is whether they can get the self-employed income scheme or they can be furloughed. The next step is to look at the contributory benefits, contributory ESA, contributory JSA, because that gives them individual income. And finally, universal credit and council tax support. But there are also lots of other things that people should be considering, such as free school meals, free prescriptions. And I think if you're giving advice to people, although these are small items, food vouchers, they actually add up to quite a lot. And when we've done some work looking at the actual financial value of all those surrounding ones, it's certainly worth people applying for them, and they're often forgotten. I think this is a final impact I'm looking at, is the differences in council tax support. And I'm not sure how many of you will be aware of the £500 million that local authorities received to help them support people in receipt of council tax reduction. This was distributed to councils based on the caseload, but the impact will vary hugely across local authorities. Because local authorities have different schemes, if a local authority has a 100% council tax reduction scheme, in other words, the poorest residents will get all their council tax met, they don't need this new money, so that can all go into a welfare discretionary pot. On the other hand, a neighbouring council that set up a different scheme where people will always have to pay 40% of their council tax, even after the application of the £150 a year additional funding, the hardship fund, they will still be left with a fair amount left to pay, in this case £27.50 a month. It's interesting that the government set out this money and it was quite prescriptive in how they should use it, that they should be giving £150 a year off the council tax bills to all recipients of council tax reduction. But there was no legislation behind it. It was just saying, you know, that's where they think it should be applied. We do know most councils are going down that route. But we're also very aware now that other councils are thinking outside the box. We've just heard from a council that is using this money completely in a discretionary way. They aren't applying it to their council tax support. They're not even relating it to their council tax support. They're using it basically to prevent homelessness. So they're looking at it to support tenancies. So I think local authorities can choose what they do with this. Most will be following the government guidelines, which is giving it £150 a month off council tax bills. But because local authorities are making up their own minds on what to do with this, I think for welfare advisors, it's really important to understand the specific local situation, and probably contact your local councils if you're working in a specific geographical region to find out what they're doing. And finally, this one we all love, surplus earnings. If you're like me, you will have forgotten about this absolutely years ago. And we all got our heads around it when the regulations first came out, or didn't get our heads around it, then ignored it as the surplus went up and up, and very few households were ever affected. But now it's back with a vengeance, because the self-employed income grant will be taken into account for calculating surplus earnings, and it'll be coming in 1 month. If you look at the graph on the right, this is a case I worked out that they were getting £1,000 UC each month. They get the grant, they get nothing in July, a reduced amount in August, and back to the normal amount in September. I think it's really useful to remember that although people affected by surplus earnings may miss some universal credit payments, they're still better off. And that's due to this high threshold of 2,500. So without the grant, they would have received £7,000 over this period, but they received £12,000. So for them, the grant was worth £5,103 and not £7,500. So they see slightly less support than people who aren't on universal credit due to that clawback through surplus earnings. But it's still worth them applying. The problem, of course, for welfare advisors is how do you advise people to keep opening their claim? How do you advise them when they're likely to start getting universal credit back in? And how do you advise them to put that aside and not spend it when they first get it? I know a lot of people on this webinar will be using our benefits calculator, and probably next week there's a release that allows you to just put in future lump sums, including debt offset, self-employed debt offset, and it will automatically calculate the next forward months of benefit, so you can advise people of the impact over the next few months. It's a real problem. It's going to be a real problem for advisors. And if there isn't much time, the advice is to just keep renewing that claim to make sure your surplus earnings is used up. And then finally, before we hear about all the details about some of these schemes from Victoria, I just want to give a thought to what's going to happen in the future. There's been quite a lot of talk about this, hasn't there, in the last week? And are the grant schemes going to be extended? They've made it very clear that there's not going to be a cliff edge. They're not going to suddenly stop. And there's talk of it going down from 80% to 60%, talk of allowing part-time work, so some sort of support for those who can be taken back into employment, but initially only part-time. Also talk about it applying only to different sectors in the future and at different rates for different sectors. We're all waiting to hear details. The thing about the grant scheme, or even though it creates this unfairness of two benefit schemes running side by, well, three, we've got legacy universal credit and these new schemes. It's a simple method to support millions of workers, and it does share the burden between DWP and HMRC. It does make you wonder if all these people suddenly came off these schemes and had to apply for universal credit, and a high proportion of them would. That is going to put an awful lot of pressure on DWP. There's also, if they end the grant schemes, what's going to happen for local authority income? And this is just a final point I want to make, is about local authority income. Local authorities have filled the gap. In the past, we've got to remember that things weren't perfect before COVID-19 measures. There were an awful lot of people falling through the gaps, an awful lot of people who did not have enough to live on. And local authorities were doing a really good job of actually plugging that gap, as was the third sector. So there was a lot of support. I mean, and food banks, of course, they don't have the resources to do that for the influx of claimants that we're expecting. The funding, additional funding for local authorities is now, it was initially promised that local authorities would not lose out due to COVID-19. That's been changed to that they have to share the burden. We've also already got local authorities looking at declaring bankruptcy. The DHP funding is not that great. It's not going to cover all these. So there will be something done about local authority funding, almost certainly. But I think we're just going to have to keep an eye out and see where that goes. Thanks, Janet.
Thank you very much, Zoe. Fantastic to hear. And everybody, if you have questions for Zoe, as I say, do pop them into the panel. But without further ado, I'm going to hand over to Victoria now. Over to you, Victoria. Here's your first slide.
Okay, thank you, and good morning, everyone. And well, thank you to the policy and practice team for inviting me to this webinar. As Janet said, so I'm head of the Low Incomes Tax Reform Group, which is part of the Chartered Institute of Taxation, and we try and give a voice to the unrepresented in the tax system. But we're also very interested in the interactions between the tax and the benefit system. Now, Zoe very kindly said I was an expert, so there's no pressure. I'm not sure how true that is, but I do have a brilliant team of people at Litrig, so anything that I can't answer today, I'm very happy to go away and get some answers. So I just wanted to very quickly, and it will be a quick kind of run through of some of the tax credit issues and then some points about the various schemes. So the tax credit system, there are still over 3 million people claiming tax credits, so it's still very important. And most of the questions that we are receiving at Litrig are around tax credits and particularly working tax credit. So entitlement to working tax credit is based on meeting certain hours thresholds, which will either be 16, 24 or 30, depending on the person's circumstances. Now, the number of hours that you work is based on your normal working hours, and it's quite unhelpful because there's no definition in the tax credit legislation of what that means. So prior to the coronavirus situation, HMRC generally accepted that if your hours were disrupted for up to 4 weeks, it wouldn't change your normal working hours if that was temporary. When the COVID-19 situation started, HMRC extended that to 8 weeks. And the 8 weeks was kind of running out this week for lots of the early people who started to see their hours reduced or who were furloughed. And so there was an announcement just in the last couple of days that they've now extended this further until the point the job retention scheme closes. Now, obviously, that the announcement end date for that is the 30th of June, but as Zoe said, it's not clear yet what's going to happen, so it's something that we just need to you know, keep an eye on. But this relaxation in the rules applies to people who have reduced hours, furloughed workers, those on unpaid leave, if they're temporarily laid off, if they're self-employed, as long as they're planning to continue trading. In those cases, there's no need to report a change of working hours to HMRC, and the key thing is that it's a temporary change. But the usual rules about reporting changes to working hours do apply if it's a permanent change. So if there's a permanent change of hours, if somebody is made redundant, then that must be reported to HMRC. And also if somebody gives up their self-employment, that also has to be reported as well. I think one thing to note here is that none of this is in any legislation yet. So some of it is still a little bit unclear as to how it works. So for example, we've had questions from people who are working 16 hours, they've been furloughed, and are asking if they take a second job, which I'll talk a little bit about shortly, and that's for 16 hours as well, can they add those two together and qualify for the 30-hour element in tax credits? And the simple answer is we haven't got any guidance from HMRC on things like that yet. So it is a case of just keeping an eye on the changes. So just continuing, Zoe referred to people who have changes to income. So even though you don't need to tell HMRC if there's a temporary change to working hours, you can report estimated income figures for 2021. You don't have to do it, but if you think your income is going to fall, then it's a good idea to do that. Just a reminder, I haven't included on the slide that there is a disregard for falls in income and tax credits. So the fall will need to be more than 2,500 compared to last year's income for it to make a difference to tax credit awards. And you must be careful in terms of advising people not to overestimate falls in income. Particularly if people might not know what their circumstances are going to be later in the year. So I've seen some people reporting very low incomes, and if they turn out to be wrong, they're going to risk overpayments. The other thing that Zoe alluded to was this kind of point that tax credits will be terminated if a claim for universal credit is made. Now, the HMRC DWP position is that most people can't make brand new claims for tax credits and other legacy benefits. I say that's the HMRC DWP position because the regs aren't 100% clear, and there is a you can interpret them that actually a wider group of people can make new claims to tax credits, but that's a very complex technical argument, and some specialist advice would need to be sought around that. And I think yesterday the Secretary of State said that they were actively looking at what they can do for people who were on tax credits and have claimed UC. Now, we've certainly seen at Littery quite a number of self-employed people who have tried to claim UC thinking it was in addition to their tax credits, and they're not going to get any UC, either because their partner is earning, still earning, or they've got capital. And they've said they are looking at that. What that means, we don't know at this point. And just a couple of other tax credit changes to mention. Again, not on the slide, but they have increased the basic element of working tax credit by £20 per week to match the universal credit increase. And this year for tax credit renewals, most people will receive an automatic renewal, which means they only need to contact HMRC if their information is wrong. But one of the things to be aware of there is that HMRC use figures reported by employers through the real-time earnings system. And that's not necessarily the right figure for tax credit purposes, because you can deduct things like pension contributions, statutory payments, the first £100 of maternity pay and paternity pay, and some work expenses. So that would obviously increase a tax credit award. So people need to check carefully. So just moving on now to the next slide, which is just about childcare. Again, I'm very conscious of time, so just very quickly to highlight the position for childcare in working tax credit is still unclear. So those who are continuing to work, so generally the key workers sending children to childcare providers, can continue claiming the working tax credit childcare element. What's not clear is the position for those who are still working, or who under the rules I've just explained are treated as still working their normal hours, but who can't use the childcare but are still being asked to pay or pay some sort of retainer. We don't have a clear answer on that in terms of tax credits, but DWP did publish information for universal credit purposes. So that's on gov.uk if you want to have a look at that, but it basically restricts universal credit childcare support to those who are, I think they've used the term critical workers. So again, I think we're waiting for some further information about that. So moving on to the self-employed income support scheme, Zoe mentioned this earlier. So the The scheme allows you to claim that taxable grant of 80% of the average monthly trading profits, and it's going to be paid out in a single instalment over 3 months with that cap of 7,500. The online service is going to be available next week, and HMRC have already started to contact people, inviting them to use an eligibility checker, which is now online, and it will give you a yes or no answer as to whether you might be eligible when the claim system opens next week. Just a couple of things to note. So the eligibility checker is only checking one of the conditions for claims, and it's checking whether somebody submitted a tax return in 1819 and also the level of profits on that tax return and tax returns in the earlier years. It doesn't check whether people still traded in 2019-20, which, as you can see from the slide, is one of the other qualifying conditions, and it doesn't check whether you intend to continue trading or whether your trade has been adversely affected by coronavirus. So just a warning about the eligibility checker, it doesn't always give the full story. The other thing that's been widely misunderstood about this scheme is the 50,000 test. So the 50,000 test is based on either profits in 2018-19 or an average over the 3 years from 16-17 through to 18-19. And that's important because we've seen people say who've done well in 18-19 because they'd been trading a while and have income over 50,000, but actually had quite low income in the other three in the years leading up to 18-19. And actually you can still qualify as long as the average, so it's an either or test, and even HMRC actually on their own webinars have got that wrong. So I just wanted to flag that up. And then moving on to some other things we're seeing coming out of this scheme, lots of people who were sole traders or in partnerships have changed to becoming limited companies during 2019-20, and they will possibly get an answer from the eligibility calculator that says they can qualify for this payment. That's not the case because you've got to have been trading as a self-employed person during 19-20 as well. So lots of newly self-employed people won't qualify for this scheme, but just to say for anybody in Scotland, there is a Scottish scheme that's been introduced to provide some help to those people, although the conditions are fairly restrictive. Janet, if we can just move forward onto the next slide, and then onto the next one, because I'm conscious we don't have a lot of time. So the job retention scheme, again, Zoe covered that, but I just wanted to flag up a couple of things that we're seeing on this. So furloughing, I'm not sure if anybody had actually heard of furloughing before coronavirus, but it's fundamentally an employment law issue, and it's not necessarily cost neutral for employers. So we've seen a lot of pressure put employers to furlough people, but it isn't always cost neutral and not always straightforward. The key thing is that it's the employer's decision. It's not mandatory. You can't compel an employer to furlough someone. So people have been confused about that. The other things that have been causing some confusion is that actually the scheme isn't just for employers who would otherwise be making people redundant, which is what was originally envisaged. So it can include people who are shielding, who have had letters from the NHS, and it can also include people with caring responsibilities. So if you can't work because you've got to look after the children, then if the employer agrees, they can furlough you. And the other one we're seeing a lot of is employers think they can't furlough staff if they're going off to work somewhere else. Again, that's not the case. They can't work for that employer who furloughs them, but they can work for others if their contract allows it. And there was also an extension of the scheme from the 28th of February qualification date to the 19th of March. And again, that caused a lot of confusion because you had to have been on the payroll and a submission sent from the employer to HMRC by the 19th of March. So if you were monthly paid and started at the beginning of March, you won't come under this scheme unless that submission has already gone off to HMRC. So like I say, these schemes are emerging and are actually, you know, we're still trying to understand what the rules are. A couple of other ones to flag up. So umbrella company employees, we're getting quite a lot of contact from. So it's quite common for umbrella companies to pay their workers national minimum wage and then top it up with a discretionary bonus. And they structure it in this way so that if the funds don't come from the agency who finds the worker, then the person is guaranteed at least the national minimum wage. That causes some issues with the job retention scheme because HMRC have said it doesn't include discretionary fees, and umbrella companies, we're seeing quite a lot refusing to furlough until this is clarified. The other thing that employers are finding difficult is the calculations are very complicated and there's no current facility to amend claims once the employer puts it in. So we've seen some employees who have been missed off the claim, and you can only make one claim per pay period, so that's difficult. And the impact on universal credit as well is interesting because as you probably know, universal credit uses the data that comes from HMRC, which comes from employers through the real-time earning system, and so UC is very sensitive to the date that information is sent through. What we're seeing is because of illness, because of all staff changes, we're seeing dates of payrolls moved around quite a lot, which is having a knock-on effect to universal credit. So just be aware of that if people are not getting what they think they should from UC, that it could be to do with the dates the employers have reported to HMRC. So I'm very conscious of time, and I will stop there.
Thank you very much, Victoria. Huge amount of content covered there, and no doubt lots of questions from the attendees. So, so do pop your questions into the panel, and I'm now going to hand over to Megan. Over to yourself, Megan.
Thanks, Janet. Hi, everyone. So I'll be covering off some of the key questions we've been receiving through our website and our chat box on our benefit and budgeting calculators from claimants and potential claimants. So we've seen a lot of queries around those who are shielding, and I think this is partly down to confusion over shielding versus self-isolating. These are new terms to most of us, so it's understandable that that's causing a bit of friction. So just to clarify that shielding is relevant to those who have underlying health conditions for which they've been deemed to be particularly vulnerable to the impacts of COVID-19. So the government has recommended that they isolate and shield for at least 12 weeks to protect themselves. So previously, these individuals would not be covered by statutory sick pay, but in the recent weeks, this has actually been extended. So if someone is shielding for at least 4 days, they will be paid statutory sick pay from that first day of shielding. However, as Victoria had also mentioned previously, the job retention scheme has also been extended to those who are shielding, but this is down to the employer. So it doesn't matter whether or not their job has seen changes due to COVID-19, even if there's plenty of work within the company, but these individuals are at high risk of going into work, they can still be furloughed if their employer agrees to do so because they're shielding. However, again, that's down to the employer. So if this is not possible, you can check their eligibility for universal credit and council tax support, along with additional avenues of support such as free school meals. And our calculator, as ever, is available to those to check their eligibility. Moving on to those who were already in receipt of working tax credits prior to COVID-19 and have perhaps seen their hours dropped or indeed have stopped working completely. So in this case, previously, as Victoria had covered, changes to earning levels and hours of work were ignored for up to 4 weeks by HMRC. At the beginning of COVID-19, this was extended to 8 weeks, but now we've seen that actually for the entire duration of the job retention scheme, HMRC will disregard changes to hours of work and earnings for those who are either employed or self-employed, and their working tax credits will continue as normal without them having to move over to universal credit. And even in these cases with reduced earnings, households may be eligible for council tax support on top of their working tax credits. So in this case, we'd encourage people to make that claim to their local authority as soon as possible. And just to be clear, this won't necessarily trigger a move over to universal credit. They can retain their working tax credit and claim council tax support. However, it's worth noting that some households would actually perhaps be better off moving to universal credit, but this can't really be applied as a one-size-fits-all policy. It really depends on the household circumstances, and for instance, if the household could bear the brunt of the 5-week wait for that initial payment for universal credit, and also factoring in that self-employed households would be subject to the minimum income floor in the future after the first year of universal credit. So all these factors should be considered before making a recommendation. So for those who are not eligible for the self-employment scheme, self-employment income scheme, this covers those who perhaps have profits over £50,000 or self-employed income is less than half of their taxable income, or indeed, as Zoe had said, someone who's perhaps become self-employed more recently and has therefore not returned a tax return for, filed a tax return for 2018 to 2019. There are other avenues of support, however, for these households. They're unfortunately not eligible for the New Style Job Seekers Allowance in most cases, because this requires households to have paid Class 1 national insurance over the past 2 or 3 years, and in most cases this won't be applicable. However, for self-employed households, they can, if savings are no more than £16,000 per year, they're likely eligible for universal credit and council tax support. So these are some of the other avenues available to them, or indeed the business interruption loan available from the government. So moving on to those who don't qualify for any support. So the two key groups here who we've heard from are those who fall into the category that they have no recourse to public funds, or also students as well. So for each of these groups, they will, if they've been working and fall into the categories as relevant to the job retention scheme or the self-employed income support scheme, these avenues are still available to these groups, as are New Style Job Seekers Allowance and New Style Employment Sickness Allowance based on national insurance contributions. However, where these schemes are not applicable, these two groups are generally not eligible for universal credit unless their partner is eligible, in which case they would unfortunately not be eligible for the couple element of universal credit, and would instead have to apply as a single person. So it may not be enough to cover all costs, unfortunately. However, at least it's plugging some of the gap. As for council tax support, if someone has settled, if someone in the EEA has settled status, they can continue to claim council tax support this year, or if they have pre-settled status and are working, many households are also still eligible for CTS, so that's worth checking. Local authorities also have some additional powers to help, so they can provide homelessness support or signpost to local charities and mutual aid groups. Yeah, so that's kind of plugging where there's certain gaps within the benefit system.
That's fantastic, Megan. Thank you so much. And that's a wonderful, a bit of a canter, but some of the most popular common queries that we've had through from the website. And I do urge other people to look at the website for other queries that we've answered. Thank you very much, Megan. Now I'm going to hand over to Peter to talk to us about how organisations we work with are responding. Over to you, Peter.
Hi, thanks everybody, and thanks Janet. It's been quite interesting so far. I did have about 10 minutes or 15 minutes prepared for today, but we seem to be out of time. So I'm going to do a very quick canter through some of this stuff. One of the things that came out of the poll, which was very interesting, was the ability to identify who the vulnerable groups were and the difficulties in doing that. And who are the vulnerable groups? Well, we know a lot of the vulnerable groups already because they've already been people on benefits who we've been talking to, and they're well known. But you know, and Megan just mentioned people being shielded, but we've got the newly vulnerable, the people who are being impacted financially by COVID-19. Thanks, Janet. And fundamentally, what we're trying to do at Policy and Practice is to help in this whole area of identifying who the vulnerable groups are. And what we're taking, what we do is we take local authority data, household level data, and we do an awful lot with it. We don't just represent it and do various things with it. But we help you identify who those vulnerable groups are. We help you engage with those vulnerable groups. We help you track what your interventions are with those vulnerable groups. I'm just taking a very brief few slides from our LIFT dashboard tracker. This is taken from a summary page. And as you see from the demonstration database, we're just looking at one ward of information within one local authority area. So we've got 1,166 households here. So we're looking at the low-income cohort. We can start looking at the policy reform over timeline. So we can start seeing what's happened over time with this group of people in just a single ward. And we can start looking at what the potential is for impact. Where should we be directing our resources? Where should we be doing this? Where should we put discretionary support? Where should we be maximising our benefit take-up and so on? And if we just focus on those areas, we're also doing analysis where we can focus on the impacts in those wards around the whole idea of who's being impacted by the recent changes with COVID-19. So we can start seeing, we can drill into those areas of support where we need to identify who those households are. So we've just identified, you know, lone pensioners living on their own, isolated when they need food. This is the street level view of that very ward I was talking about, the 1,166 households, as you can see. And you can see along the top, we can start drilling into these households to look at the impacts of financial resilience, universal credit changes, welfare reform changes, and looking at to see are these households making the maximum of their benefit take-up. And if we drill into those by looking at a couple of areas, so if you say who's likely to be impacted by the third child rule, or who is self-employed, so picking up on this whole area of people impacted by tax credit systems, so the self-employed. And if we drill into that, we've now identified 14 households. But who are those 14 households? We can see where they are there. But what I can do is I can download that data. If we go to the next slide, you can see how we can download that data and we can do more analysis with it. And doing that more analysis may mean that we identify their houses. And that means that we can then look at these 14 households, the same 14 households, and start looking at outcomes trackers. We can change the start date and end date when we're looking at our data. We can start looking at things like that. You can see I can start looking at how we're looking at the arrears greater than £250, two-thirds of the way down on the left-hand side there. We start seeing how many have been moving into greater arrears, how many are coming out of arrears, and where should we be putting our resources to support these particular households. And there's a whole range of information, excuse me, where we can track that. So this is just looking at some tracking of about 82 households moving in and out of different levels of debt. So we can start understanding what is taking place across the organisation. So when we're trying to identify who the households are, we can start doing it. And drilling into a single household, we can see in this particular household, part of that cohort, we've got 2 adults, 5 children in the household, which is boxed in the centre there. We can start seeing what's happened to them over time in terms of debt and so on. And on the right-hand side, we've got a box which identifies where should we be putting our resources to support this household? What may they be eligible for in terms of receiving more support from us? So if we're looking to say we need to do more on identifying our household level information, data is the key to that. Data is the key to where we can unlock our resources and target our support to these people in a better way. And that ultimately allows us to drill into the calculator. So for those organizations and a lot of CABs and housing associations on the webinar this morning, we can pinpoint people to look at the calculator. We can identify who people are in the calculator. So this is somebody called Janet James. As we drill into this particular person, let's go to the next slide, Janet. So we're looking at in the calculator. We can see this person is in work, they're self-employed, but they don't have access to the minimum income floor because of the recent changes. So we're not going to apply the minimum income floor because of the recent changes. If we start looking at the impact of that in terms of the results, we can see exactly within the calculator what benefits they're eligible to receive. And the question that Zoe rightly asked is, is this individual likely to be better off under universal credit? And if we click to the next slide, we can see the same slide that Zoe showed earlier on, where they're £87, £70 better off under universal credit. What's interesting about this particular household is when they come out of the minimum income floor is reapplied, they will be worse off again. So if we look in the red box on the right-hand side, you can see that currently under universal credit, they're receiving £1,078. When we disapply the minimum income floor, we apply the minimum income floor again, sorry, they're down to £819. So they will be worse off. So it's looking at scenarios within the calculator will really enable you to provide support to organizations and to individuals and to households to make sure that they're able to maximize what they're able to receive. And we provide further guidance within there. So on the right-hand side of the panel, we have a universal credit payment calendar. That's where we're going to be putting surplus payments in there, surplus earnings in that area. And the guidance for this particular household is showing, highlighted in red as the major area of support, surplus earnings and information about that, and all those other areas where this particular household could gain more support financially and with guidance. The important thing is, how do we identify these households? Who are they? Where do we target our support? If we're a housing association, we could use the calculator in a self-serve way. So we could enable people to, you could embed this. So this is a page from the Kingdom Housing Association, who recently become a client. This is their website, and embedded into their website is the calculator, as you see in the middle of the bottom there. And when a resident fills in a calculation in, you'll see the button there, send to advisor. They will get advice that this resident has done stuff. So for tenancy sustainability, for ensuring people are getting the maximum support and providing consistency of advice across the team, this is an ideal way of enabling you to support residents. So what we're trying to do, just to wrap up, is identify who is eligible for support and what support can you provide to them, and providing that best of advice to give to each individual household. So that was a very quick canter through there, but I'll hand back to you, Janet, in terms of wrapping up any questions people may have as we just run over time slightly.
That's fantastic. Thank you very much, Peter, and also Megan and Victoria and Zoe as well. I have some questions through from people, so thank you very much. I'm going to start. I know we did say we're a tiny bit over, so do bear with me while we go through some of these questions. And I do say we've got quite a few here, so if I don't get to them, we will follow up after the webinar with particular answers to the queries that you've asked. But let me just start by, I think this question is for yourself, Victoria. Why do subcontractors that are employed on an as and when employment still have their UC taking the minimal self-employed ceiling rather than what they're actually paid by the contractor? That sounds a little bit complicated. I mean, do you want me to repeat that question?
Yeah, if you could.
Okay, so I think this is a question about subcontractors. So why do subcontractors that are employed on an as and when, presumably as and when basis, when they have employment, still have their UC taking in the minimal self-employed ceiling rather than when they're actually being paid by the contractor?
Well, I mean, when you get into, I mean, it depends on the exact employment setup. So are they employed or self-employed? Because it talked about, you know, employment. It sounds like these might be self-employed contractors, because sometimes if you're a contractor, the person you're working for deducts tax and national insurance, but actually you are still self-employed and fill in a self-assessment tax return. So you would possibly come under the self-employed rules for universal credit, and that might be meaning the minimum income floor, although obviously currently that's not being applied. But I'll perhaps follow up on that as well, because there's lots of possibilities actually in that question.
Excellent. Okay, thanks, Victoria. Another question here about people with no recourse to public funds. So any support for clients who have NRPF as a single person, was previously working as self-employed but hasn't made sufficient tax payments. Any thoughts on that?
I know that if they haven't, if they can't access the coronavirus job retention scheme or the self-employed scheme, there is no support for people with no recourse to public funds. It's one of the big groups, those and students who were working and supporting themselves through working, who fall through the welfare safety net. Absolutely. There was a question in the House of Commons about this last week, and the government has promised to look into it. But it's anyone who's following welfare and news knows that this is a major problem at the moment. Homelessness, they have been included in the local authorities group that they have to give homelessness support to for the period of coronavirus, but that's only when they're fully destitute, and really there needs to be some sort of welfare net before they get to that stage. I would just urge everybody to put pressure on to bring forward what the government is already saying it's considering.
Great, thank you, Zoe. I've got a couple of questions here specifically around furloughing, so I'm going to tie them together. I hope not too annoyingly, but one question: if the employer was late to submit the furlough claim, is there any other option for them? And then secondly, somebody else asks, is it possible to apply for contribution-based JSA if you are furloughed? Not sure who wants to take the first one on that one.
Oh. I can certainly, I think, well, try and answer the first one. So, I mean, it depends what you mean by a late claim for furlough, because actually there isn't any specific deadline. I mean, what HMRC are trying to get employers to do is apply roughly in the same way their pay cycle works. So if they've got monthly paid people, you apply to the scheme a few days before you run the monthly payroll. But obviously not all employers were able to keep paying people, and so they've had to make kind of catch-up claims, and some employers, I'm aware, that they've decided they have been able to keep paying people, and they're actually going to make their furlough claim just one claim at the end, kind of in June, to cover the full period. So you can set the claim period as to whatever you want. So but in the interim, I guess if the person themselves hasn't had any payment, then they would have to look at the benefit system. But obviously when any earnings are paid by an employer, if they're on UC, for example, it would then come through on that RTI feed, possibly as one lump sum. And that's what I was referring to about the sensitivities of universal credit to the data coming from employers.
Okay,
I've just read that the furlough scheme is going to start being wound up in July. It's been announced by the Chancellor this morning. Got no details. It'll be interesting to see what happens to that.
Yeah, just on that second question, Janet, so when someone is furloughed, they're technically still employed, so they would not be able to claim any type of job seekers allowance. So that new style JSA would not be on the table for them, because there's in order to receive JSA, you need to sign a commitment that you are ready for work, and obviously if you are currently in work, that's not applicable.
Great, thanks Megan, thanks for clarifying that. Just another question here, a particular instance of somebody who knows somebody who is a bus driver, and he said all bus drivers are furloughed for 3 weeks, then working for 3 weeks, then back on furlough again. You stated you can only be furloughed once. How can they be working in this way and funded by furlough in this way?
Okay, so what I was covering there was that employers can only make one claim for one pay period. So that was trying to just explain, because we've seen people where the employer has submitted their claim, let's say to cover a month's period, and they've missed an employee off the furlough as a mistake, you can't go back and make another claim for that same claim period. What this question is referring to is kind of just generally furloughing people. So the minimum is that you can furlough people. They've got to be a minimum of 3 weeks, but you can do exactly what that company are doing. So you can furlough for 3 weeks, bring them back, then you can put them back on furlough. You could furlough somebody for 6 weeks, then end the furlough, bring them back, and then put them back on furlough. So there is flexibility. What I was talking about was making claims, the employer making a claim through the online furlough system to get the payment from HMRC.
Brilliant. Thanks for clarifying, Victoria. I have a question here from somebody who says, hi, should we be advising clients who would be better off on UC in the short term of the long-term implications, i.e. they could end up worse off longer term and possibly unable to go back onto legacy benefits, for example, self-employed people?
Yeah, I think this is absolutely necessary, and I think this is something that Peter's demonstration showed completely, that for anybody who's thinking of switching, you really do need to know the implications. You need personal support. The example Peter showed was on our benefits and budgeting calculator, but whether it's manual or through a calculator, but to show actually not just to look at the 2 options now, but to also look at the options that will be further down the line when these, and I think we have to presume that some of these measures are temporary. There's a lot of hope that the LHA rate, the £20 increase will happen, that MIF won't be reapplied, but I think at the moment they're temporary and that's what we have to base it on. So I think all that has to be taken into consideration.
Thanks, Zoe. Anything to add to that, Victoria?
No, I mean, just to agree, I think you absolutely have to make people aware. I mean, people are in a kind of a crisis situation. They've lost their income, and it might be that they have no choice but to move to UC despite the long-term implications. But at least being aware of what's going to happen in the future means they can make an informed decision, and I think that's really important.
Yeah, lovely, thank you. I think I'm going to make this one the last question. I do have more. Apologies if I've not covered all of your questions. Like I say, we will give one-to-one advice on every single question that's come up if we've not covered it in the webinar today. So please do bear with us. So this is the last question. An example here, we have someone who was paid on the 30th of March, applied for UC on the 31st of March, but the employer has details on the wage slips that it was paid on the 31st of March. Therefore, UC have taken into account the pay and they have in turn received no UC because they were paid 1 day early. Any advice for that situation?
Yes, I mean, this is something that was happening before the coronavirus situation. I think we're seeing things like this happen more now because of what I said about disrupted payrolls. I mean, it's actually a really complicated process of the moving of data from the employer to HMRC to DWP. The key thing to be aware is that DWP use the date they get the information from HMRC to determine which assessment period it falls in. What determines that is what date the employer puts on that submission. HMRC guidance to employers actually tells them to use the contractual pay date and not the actual payment date in some cases. And so that, we see people caught by this all the time because they've been paid on a certain day. So they assume they're fine to claim UC and then that won't count. But it's the date. So like I say, HMRC do tell employers to use the contractual pay date. So that might account for why this has happened. In terms of what you can do about it, well, you can appeal, so you can ask for a mandatory reconsideration. I think if you have a look at the Child Poverty Action Group website, there is some information there because they have taken a case called the Johnson case that has tested this, and they were successful, but DWP have appealed it to the Court of Appeal. So there's some advice there about how you can ask for a mandatory reconsideration, and also have a look at the Universal Credit Regulations because there is some flexibility for the DWP to look at disregarding and treating it as in a different assessment period, but that probably might not apply in this case. But do have a look at that CPAG information and just be aware of this issue, and because it is common, it's happening a lot at the minute.
Brilliant, thank you very much. So
I would like
anything
to just
add?
add, yeah, no, nothing else to add. That was absolutely brilliant answer, and exactly, yeah, and nothing else to add to that. But I would just say that for the welfare advisors out there, I think it's really important that when we advise people, we do advise them, and this isn't this particular case, to wait till any outstanding pay, if they're moving over to universal credit, is in their bank account and apply the day after that. It's because people are applying, they then get back pay, they get paid because of these disrupted payrolls, exactly as Victoria was saying, later than they normally would, and they then end up with a 9-week wait for support rather than the 5-week wait. So it does, unfortunately, this does exactly come back to the very first question, going round in circles in here, is finding the people who need support, because everybody would benefit from individual support, and these are the sort of things to be that when you're working with somebody you can assist them with, but it's very hard to put out general rules.
And just to add to what Zoe said, it is very difficult in these cases because you, as an advisor, you can ask the claimant, you know, when did you get paid? And you can see that on a bank statement. What you won't be able to tell is what date the employer put on the submission to HMRC, and that will, in most cases, drive when the data goes to DWP and which assessment period it falls into. So it can be difficult to know how long you need to wait to apply for UC, so that payment isn't taken into account. So I understand it is difficult.
Brilliant. Well, thank you very much. I think, like I said, we have more questions, and I know that we could go on and on because it's very interesting and huge complexity to cover here. But we will get back to you if we've not covered your question. We will get back to you separately offline. And thank you very much for all your engagement. Now, I just want to continue this theme of tools and help, and just to point you to a couple of supports that hopefully you might find useful. The coronavirus page that Zoe talked at way back at the very beginning, that is the URL there. So policy and practice .co.uk/your income and coronavirus COVID-19. So do please take a look at that. We're updating it as and when new information comes out, and you can download all of the information in a PDF as well. It's currently quite a long PDF, but it is in a good printed format. There is also a link on that page to our free benefits calculator, which is one of the 3 calculators listed on gov.uk. Very heartening to see DWP put out communications this morning encouraging people to use free benefits calculator, and indeed a lot of the messages we're talking about today, which is to do a benefits calculation before any changes are made. So that's our free calculator, but also you can have a look on our website. We have a more sophisticated professional version of the calculator, which is a lot of the features that Peter ran through, and again you can look at that on our website as well. Peter talked about the self-service calculator. You can find more information about that on our website, or indeed in the follow-up survey, which is going to happen just as soon as I close this webinar. There's more information there, and indeed pop your details in there if you want us to get back with any specific information on those pieces of software. Our next webinar, and we would love to see you on that webinar as well, again very much about coronavirus. Is there anything else to talk about? We are going to be talking about stories from the front line, and our guest speakers there are Ellie Kershaw from London Borough of Tower Hamlets, and also Grant Bailey from Cheltenham Borough Homes, who are going to share their past, present and future experiences of dealing with coronavirus on the front line. So we welcome you to join us on there, and again do auto register. The link is in the survey. So without any further ado, and I do apologize for taking you over time today, but hopefully you found it a very useful webinar. But I would like to give sincere thanks to Victoria for joining us today. Victoria's website details are up there on the screen, and also to my colleagues Zoe and Megan and Peter. Thank you very much, everybody, yourselves for joining us, and I hope to see you on a policy and practice webinar again soon. Thanks. Have a great rest of the day. Take care, everyone. Bye-bye.